Hello, welcome back everyone. In this video, we're going to continue with chapter 8, how to buy, finance, and insure a car. In this video, we're going to go over the financing portion. Let's get started. We already said that your budget is your primary tools for deciding how much car you can afford. How can you pay for a car? You can always pay cash for the car. This is not an option for a lot of us. The trade-off between paying cash for an old car that is less reliable versus a newer used car or even a new car is the opportunity cost and the future repair cost. A lot of us will need to take out a loan to finance a car. Something that you may not realize is that credit unions and community banks usually have much better rate than car dealers, especially if you're looking at a used car. In addition to credit unions, mutual savings bank, and also regular bank, commercial banks sometimes has better rates than car dealers. In preparation, you should get a copy of your credit report, find out what your credit scores are, get a copy of your credit report, make sure that there are no errors in it. And you can go to get to a lender, which can be a bank or a credit union, and get a pre-approval. If you get a pre-approved loan, then later on when you go and negotiate with the dealer, you don't have to worry about financing. This is a potential consideration. Remember that a cosigner has a lot of responsibility. A cosigner basically says that if you do not make your car payment, they will make the payment on your behalf. That is what a cosigner does. So this is a huge ask. But if you have someone in your life that's willing to do that, you may consider that. If your credit score is very low, then you may need a cosigner for a car loan. And if you do not have any credit history, that may be the case. If your credit score is moderate, then having a cosigner may enable you to get a lower interest rate. Remember that this is a huge ask and a huge favor. If you do end up getting a cosigner, make sure that you have run the numbers and that you will be able to afford the car payments. In addition to borrowing money to buy a car, you can also lease a car. A lease usually gives you less flexibility than taking out a loan. We'll talk about lease versus buy in a later segment in this chapter. There are some car dealers that advertise as buy here, pay here. These car dealers do not separate financing from the car itself. And most of them have a very, very high interest rate, and their cars tend to be very old and have high mileage. These are not dealers that you want to work with. Since taking out a car loan is the most common option for us, let's take a deeper look. How do you shop for a car loan? A car loan is a secure loan, meaning that the car is going to be used as a collateral. If you don't make the car payment, the lender can repossess the car. The lender will care about something called the loan-to-value ratio, or LTV ratio. The loan-to-value ratio is defined as the loan amount divided by the car's value, and this affects your down payment. For example, if the lender requires an 80% LTV ratio, that means they will loan you 80% of the value of the car. If the car costs $30,000, then the lender will be willing to loan you 80% of that, or $24,000. That means you have to come up with $6,000 as down payment. The second factor that is important when getting a car loan is how much interest you are paying. The APR varies from bank to bank, so it's a good idea for you to get pre-approved by your bank or your credit union first, and that will allow you to negotiate with the car dealer. Most of the time, as we mentioned earlier, credit unions and banks typically have better interest rates than car dealers. However, new cars is an exception. A lot of times, new cars have special APR offered by the manufacturer to promote their products. Another important factor that affects how much your car payment will be is the length of the loan. Longer loans will have lower monthly payment. of course, you have to make the car payments for longer. With cars, it is a depreciating asset, so it has a particular danger of taking out a loan that is too long. A long-term loan can lead to what we call an upside-down situation. You are upside down when the money you owe, meaning your loan amount, is higher than what the car is worth. Do not be misled by lower car payment that has a very long loan period. The book goes into a few more examples, but basically keep in mind when you buy a car how many miles is already on it, how many miles you plan to drive each year, and figure out how much life is remaining in the car. You definitely do not want to take out a loan that is likely to be longer than when the next major repair may be needed for the car. You want to pay attention to the fine prints in the loan agreement. Avoid any loan that has prepayment penalty. If you have a loan that have prepayment penalty, it will be costly if you change your mind and want to sell your car early or trade in your car early. Also, if interest rate goes down in the future, you will have the option to refinance if you don't have any prepayment penalty. The last thing to watch out for are add-ons. These are less likely with a bank or a credit union, but very common with dealer financing. These include credit insurance or gap insurance. Credit insurance is insurance for the lender. We talk about this a little bit in chapter 6. If you are the one paying for the credit insurance premium, and if you fail to make the loan payment, the insurance company will then pay the lender. A gap insurance, this can be important. A gap insurance cover what your insurance cover and the loan value. So when you take out a car loan, we'll talk about that car insurance in a little bit, you are required to take out a car insurance so that if you do get into an accident, then because your car is the collateral, the insurance company will pay the value of the car. However, the value of the car may not be enough to cover the loan value. And some lender will require you to buy a gap insurance. The gap insurance covers what your automobile insurance will pay versus the loan value. Let's take a look at an example of how the length of the loan will affect your car payment and what an upside down situation looks like, and when you have an upside down situation, how gap insurance will work. Here's the same car. The car's cash price is $25,000. You can finance it over 4 years, or you can finance it over 6 years. The interest rate is slightly higher for 6 years. That is not uncommon. So longer term loan, we talk about that. That is the long-term loan premium. In interest rate, you typically find that long-term loan has a slightly higher interest rate than shorter term loan. So the 4-year loan has 4 years, there are 48 months, and 6 years, there are 72 months. We can compute the monthly payment. We learn how to do that in chapter 5. The function we'll use is the payment function. We have the interest rate 9% divided by 12. And we have the term, which is 48 months. The loan amount is $20,000 in both cases. The monthly payment for the 4-year loan is $497, almost $500. And for the 6-year loan is $370. So that's a huge difference. The monthly payment is $120 less, but you have to pay 72 months versus 48. More importantly is what happened to your loan balance. It's the same cost. Let's say you drove the car for 2 years, and now the car has depreciated after 2 years, and the car is worth $10,000. With the 4-year loan, after 2 years, the loan balance is $5,000, $5,691. So your equity in the car, meaning how much you owe, is yours, is the difference between the value of the car and the amount that you owe. So you have $4,300 in equity. So what that means is if you trade in the car at this point, you will get $4,300. If you take out a 6-year loan and make only $370 per month in monthly payment, after 2 years, you owe $11,483. That's the amount that you still owe. The car is worth only $10,000, so you're upside down by $1,483. When this happens, if you want to trade in the car at this point in time, you have to pay the lender $1,483. If your car gets into an accident and the insurance company paid you the $10,000, which is how much the car is worth, you still owe the lender $1,483. And this is what the gap insurance will cover. Remember that a car is a depreciating asset. Taking out a loan that is too long can get you in trouble. We talk about leasing as a financing option. Is leasing right for you? It depends on your own individual circumstances. There are some advantages of leasing. Leasing has a lower monthly payment, and that is because a lease has a residual value. This is the amount this is the optional price that you can pay to buy the car. Remember, when you lease a car, you're renting the usage of the car. You do not own the car at all. The residual value is what the estimated market value of the car is when the lease ends. The disadvantages of leasing is that, first of all, you don't own the car. And the biggest danger is that most leases come with a mileage quota. So this is how much the lease allows you to drive per year. If you exceed this quota, you have to pay a penalty, and that can be very expensive. There's also penalty if your car if the condition of the car shows excessive wear. Also, if you want to terminate the lease before the term is over, you can have a huge penalty. So this is very important. Some leases have prepayment option, meaning that you can pay off the lease early and buy the car outright. If they have that is an option. But if otherwise, you will be stuck with all the lease payment before the term ends. Finally, what they said, leasing means that you don't own the car. You have no equity at all built up in the car. Another important thing to remember is when you lease a car, you are still responsible for all the maintenance, especially damages and excessive wear and tear, and insurance on the car. We'll end this video here. In the next video, we'll talk about auto insurance. See you soon.